Hey guys, it's DT and welcome to the Cash Pod, your go-to guide to building a bigger, better cash flowing business. Thank you for spending some time with us today as we cover all things growth. Today, the conversation is going to be all about sort of the one-on-ones on when do you know if it's right to raise money, where do you get money from, how do you think about debt financing, and what is this strange thing called raising, capital by selling equity to investors. We'll touch on it all. Really excited to dig in. We've got an incredible special guest, also the producer behind the Cash Pod, the OG, Samia. Let's get into it.
Hey guys, welcome back to the Cash Pod. Your favorite duo back at it, or maybe not. We don't know, but we thought it'd be useful to do a quick episode on. We've touched on this before on other platforms, but we've never done like a proper, maybe just like a quick one-on-one session about financing and lending and loans and I guess kind of like if you're a business and you're like doing well, you're making money, you're profitable, or maybe not, and you're like, how do I take my business to the next level? How do I up the ante and grow? And to grow, you need money, right? So DT here is gonna give us all the tea, the ins and outs of it, and what lending is good, what's bad, what is useful for like your particular size of business, and how to use that money usefully too. And we'll get into debt and how it's actually not a bad thing, and we'll do all the things. So, hello DT, happy Friday.
Happy
This is
Friday.
coming out on a Monday probably, but okay, I guess I'll just start with the simple question of what are the options for lending and financing? Just TLDR.
So, when you're thinking about debt financing, the and the sort of various types, the most important thing to actually start with is like, what do you need money for, right? Because the truth of the matter is that the lending space in the lending world is pretty vast. And the key to success is finding the right product for the right use case, right? The right product for what you need money for. It's not about the one product to, rule them all. It's in Lord of the Rings, right? Like it's the right product, right use case, and putting it to work in the right way. And so part of that is also understanding that there are a lot of products that you might not even have thought of, right? There's your classic business loan, which is a term loan, where an institution or a lender is giving you a lump sum of money and that you repay that money over typically a little longer period of time with interest, with typically fixed monthly payments, depending on the structure. That's your like classic small business loan. Then there are lines of credit. Everyone wants a line of credit. Think of it like essentially a much larger sort of business credit card where you can actually tap into a certain amount of dollars and then pay off those dollars with interest over a certain period of time. One thing about those two products, typically every business wants a line of credit because it allows you to flex and use that capital when you need it versus just taking all the money out at once. But what ends up happening is most businesses use a line of credit like a term loan, ending on the term loans and lines of credit. So that's how you should be thinking about term loans versus lines of credit, right? Really great products for your business. Term loans are good for longer term investments in your big business. Lines of credit are really, really good products for really as like an insurance policy, right? Maybe you have months that are fluctuate from a cash flow perspective. That's what you really want to use line of credit for, and pay it off quick. Because again, lines of credit are more expensive than term loans. If you use it like a term loan, you're potentially spending too much money on that capital, right? There are a lot of other products too. Say you're purchasing inventory. You can finance the purchase of that inventory. Say you have accounts receivable in case someone's going to pay you money or an invoice or a purchase order from a large retailer. You can get financing against that. Say you want to purchase equipment. There's equipment financing, right? For you to be able to actually use someone else's capital to purchase that equipment and pay it off over a period of time. The key to the game is right product, right use case. And that's part of what we do here at Bags is help you understand the intricacies of those products.
So, since there are so many types of financing and loans and everything like that, how do you know like when it's time to get external funding?
Good. I think timing is actually like probably one of the most important parts of this conversation because typically when businesses are looking for capital, they're doing so in a pretty reactive state, meaning they're moving and seeking capital at their point where they actually need the money, right? In a tight time period. The problem with that is typically that also coincides with when your business isn't necessarily at its highest position of strength and you expose yourself to the risk of what happens if it just takes a little bit longer than you thought.
Right.
Right? And so the name of the game when you're seeking capital is to do so proactively. It's not actually to do so in the middle of your down period if your business is seasonal. You should do so right during or after that high period when your business looks as strong as possible. So that's the first piece, just in terms of proactive versus reactive. Then the next piece is, there should be a direct correlation between seeking financing and business growth, right? Meaning you should be able to directly articulate how that loan could help drive more revenue or increase cash flow within a period of time, right? And once you've reached a point where your business isn't able to grow to that next level because of a capital constraint, but if you were able to add more capital, it would result in more revenue or more cash flow, or AKA more profit, right? That is when you should be thinking about debt financing. So most of those times, right, like you can kind of identify when they're coming, right? You just signed a big new retail contract. You just signed your biggest new construction deal, right? Like you kind of know it's on the way. It's about as soon as you see that on the horizon, being proactive, getting your books in order, which we're going to talk about, and then going out into market and seeking capital before you really need the money so that you have the highest likelihood of actually receiving that capital and expanding into that growth opportunity.
Cool. Okay, that's good to know. So my second part of the question is, I guess, like, what are red flags in funding, lending, loans that people need to watch out for, like interest rates, or if it's like, I know we always talk about like a get cash fast scheme, like how do we kind of avoid those and make sure that we're going to credible sources and making sure we're getting good loans?
Listen, part of the problem with being reactive is that it forces you to end up taking out faster money that is typically higher interest. So there's usually a direct correlation between how quickly you get funded and how predatory or expensive that product might be, right? So if someone's offering you capital in 2 days, guess what? There's typically some bells and whistles that are pretty expensive as it relates to that product, right? And so for you, like the real red flags are anyone who says, hey, I'm going to give you money in 2 days, usually it's too good to be true. It doesn't mean you can't get the capital, but it's going to mean the cost is going to be really, 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 really expensive. Almost more expensive or even more expensive than credit cards, right? So that's the first thing to look out for. Second, it's always good to have more than one conversation with a lender. Right? There's different types of lenders who lend capital. Everything from banks, who don't really do small business lending nowadays, but from banks to credit unions to private investors, private credit's a big space, to various types of other lending structures and vehicles. And then there are these things called CDFIs. We encourage all small businesses to get to know CDFIs. Look it up, Community Development Financial Institution, but just look up CDFI in your city or state. Get on the phone with them and start to build a relationship. It's the best place for you to get affordable capital for your business in order to fund and fuel your growth, especially if you're looking for a term loan, right? So the red flags are like, do your homework, look at the fine print, ask the lender whether they're filing a UCC or a lien on your business, right? And then really make sure that you've got the right partner who's able to work with you long term. Like getting ahead of that is key. And it shouldn't necessarily be here's a bank statement, here's the money. If it's too easy, it's typically resulting in potentially something that is predatory that could hurt your business.
And then what do you need to apply for a loan? Do you need to be profitable?
So there are variables of your business, amount of revenue, whether you're profitable or not, your current personal credit score, potentially your business credit score, where you're located, what you sell, what you're going to use the money for is key. They want to see that the money's going to go towards things that drive more revenue or cash flow, right? And so that's sort of the profile of your business. And then the actual thing that usually slows down the process is you don't have your books in order. Right? Every lender is going to require an up-to-date P&L, cash flow statement, balance sheet, debt schedule, a schedule of all of your current liabilities, your tax returns. Pay your taxes, guys. It'll help you get access to capital. If you do not have those documents and those documents aren't up-to-date and prepared, that is actually going to be the thing that limits your access to capital, results in the business. It results in you getting funding. It results in the funding process being longer and in turn decreases your likelihood of being approved. And if you're not sure whether your books are up to date and in order, check out Bags. You can use a 1 month free code, morebags25, and we'll give you a free financial document review. All you need to do is link your QuickBooks and you get an automatic analysis of whether your docs are loan ready or not. And if they're not, go back to your accountant, yell at them, get it to be right. And if you hate your accountant, don't worry, like we can help make sure that they're up to date.
This episode's one big plug. No, but actually, like, in all seriousness, like we offer all these things if it feels daunting. Like, we have a very dedicated group that can help figure this out for you. Okay, I did want to ask about investors. I know it's like a bigger conversation, but it's like a little bit more daunting, I think, because you can't really Google like investors near me. So how does that process work, and when is that useful for a business?
So truthfully, most small businesses don't end up raising equity capital from individual investors, right? That's just the truth. The vast majority, then if you think about venture capital, the vast majority of businesses don't get capital from venture capital firms. And so typically 99% of businesses are using debt to fund. It doesn't mean you can't raise equity from people. Equity, if you do raise it, should be used to fuel and fund the moat within your business, the things that take the longest to manifest. Don't use equity to fund things like marketing or inventory spend. You're selling your car to buy gas, right? Like, it makes no sense. And so, seeking out investors, building relationships with them, something that you might want to do, but really focus on driving more revenue. If you can figure out a way to use debt capital to drive more revenue, it's a lot of what we do with our businesses. That's where you should spend most of your time versus seeking out investors.
Okay, cool. And then for anyone, aka me, I don't really know much about equity. Can you just in simple terms, like, does every business have equity, and what does it mean to give up equity, and when is that kind of like scary or useful for a business?
Absolutely. Equity, best way to describe equity in your businesses is ownership value. And every business has equity within it, both monetary and other. But when you set up a business, there's ownership structure, and that ownership structure defines who owns equity, right? And typically whoever has the majority equity in your business gets to make the decisions, right? Over time, depending on some of the nuances. And so when you give away equity to an investor, you're giving away ownership, and equity stays with your business forever. Meaning, once you make $1 million of profit, right, and you pay off whatever loans you need to, you make your loan statements. If there's $1 million left at the end of the year and you want to do a distribution, that goes to the owners, divided by the percentage of ownership that they have, right? And so equity never leaves your business unless you sell it, unless you restructure. So giving away equity is typically so much more expensive. It can be very, very useful. It's the right values aligned to partner, but the goal of the game is like keep ownership. That's the value of your business.
Okay, that's really good to know. I hope everyone listening learned a thing or two. Quick episode, but really good nuggets of information in there. I definitely learned a lot, so thank you. And we'll see you on the next one. Bye, guys.